Who is pulling the strings behind the Iran-Israel war, and who is reaping millions in profits while the world watches in horror? From the first outbreak of violence and bombings to the direct response by the United States, we have witnessed a conflict that transcends the rhetoric of opposing sides to become a vast geopolitical chessboard where pawns are worth less than contracts. As rockets streak across the skies and sirens warn of imminent danger, casualty numbers quickly turn into statistics inside government offices and intelligence agencies. There, behind armored doors, decisions are made not solely out of revenge or national defense, but according to market dynamics, the influence of arms lobbies, and the ambitions of political leaders seeking to consolidate domestic power or project external strength. In recent weeks, the price of a barrel of oil surged by 18%, surpassing $105 in major international markets. This funneled hundreds of billions of dollars into the accounts of the largest oil companies. Corporations like ExxonMobil and Chevron reported quarterly revenue increases close to 15%, a windfall largely distributed as dividends to investors. Major pension funds and energy-focused hedge funds quickly adjusted their portfolios, shifting from fixed income assets to oil-based investments, triggering a further rise in energy sector stock prices. Simultaneously, the defense sector experienced a historic wave of orders. Lockheed Martin signed over $4.5 billion in contracts to sell Patriot missile systems and F-35 fighter jets to Saudi Arabia and the United Arab Emirates, both members of the coalition providing logistical support to Israel. Raytheon Technologies announced a 30% production increase at its Arizona plant to meet the demand for anti-aircraft systems. Northrop Grumman reopened manufacturing lines that had been dormant since the end of the Afghanistan war, now dedicated to producing components for attack drones, tools that are becoming increasingly decisive in this conflict. The numbers don't lie. The combined market capitalization of the arms sector rose by about $80 billion in a single month, a 12% increase that demonstrates the direct correlation between military escalation and corporate profits. Meanwhile, poverty and unemployment indices in conflict zones have skyrocketed, creating a breeding ground that perpetuates instability and fuels the cycle of violence. On the political front, leaders seeking to improve their domestic approval ratings found in the conflict a favorable stage to present themselves as guardians of national security. In the United States, the Trump administration, despite being in an electoral transition period, framed its military intervention as a preemptive act of defense, a narrative that solidified support in key Midwestern districts where the oil and gas industry employs tens of thousands of workers. At the same time, stock values in those districts saw significant upswings, and several congressional representatives, whose campaigns are heavily funded by major energy conglomerates, reinforced their tough-on-security rhetoric. Meanwhile, European investment banks, eager to capitalize on the sharp market movements, expanded their trading operations in commodities and currencies tied to oil and the US dollar. One of the biggest beneficiaries was Goldman Sachs, which closed the quarter with net earnings 25% above projections, largely thanks to energy derivative brokerage fees. This war has also served as a catalyst for a new phase in the technological arms race. Israeli corporations like Elbit Systems, a supplier of surveillance and reconnaissance systems, have seen their exports grow by over 20%, not only to regional allies, but also to European and Latin American nations eager to replicate sophisticated missile defense systems. Every downed drone and every radar installed represents a new order in portfolios that now exceed $6 billion in value. Behind the scenes, geopolitical hedge funds use algorithms to process news, leader tweets, and troop movements to generate real-time market price forecasts. These systems, developed by firms like Jane Street and Two Sigma, have allowed clients to achieve extraordinary returns by exploiting the volatility sparked by each bombing or official statement. What remains hidden from mainstream narratives is the extent to which intelligence sharing agreements and joint military-industrial ventures expand during wartime. For example, U.S. private military contractors like DynCorp and Academy, formerly Blackwater, have seen a spike in recruitment and overseas deployment contracts. These companies operate in the gray zone of legality, often bypassing conventional regulations under the guise of national security. The war provides cover for the proliferation of private armies whose operations rarely make headlines, but whose bottom lines explode in times of conflict. In parallel, tech giants supplying AI-driven military tools have entered the fray. Microsoft and Palantir have secured multi-million-dollar contracts to provide data analysis platforms capable of processing battlefield intelligence in real time. These technologies, initially designed for counterterrorism, are now deployed to predict enemy movements, optimize supply chains, and even suggest targets. Each new deployment means new funding rounds and boosted share valuations. Economic interdependence deepens as European NATO allies, alarmed by the regional destabilization, increase their own defense budgets. Germany has already pledged an additional 20 billion euros to military modernization. France, meanwhile, has accelerated arms exports to Israel and its partners, citing defense treaties and regional stability. These measures indirectly reinforce the profits of the global arms trade, even for countries not directly involved in the war. The media industry, though often cast as a neutral observer, also sees revenue spikes. As audiences surge, advertising rates rise. News conglomerates package war as spectacle, real-time footage, expert panels, dramatic graphics, turning suffering into consumable content. War becomes not just a headline, but a product with measurable engagement metrics. Beyond even corporate gains, this conflict reshapes geopolitical influence. Nations supplying arms or diplomatic cover gain leverage in international negotiations. Deals unrelated to the conflict, such as trade agreements or energy accords, are rebalanced based on wartime alliances. Those who align strategically benefit far beyond the battlefield. This alignment isn't just theoretical, it materializes in how military support becomes bargaining power. Countries like Turkey and India, maintaining nuanced diplomatic stances, now find themselves courted by both sides of the global divide, seeking their influence in multilateral forums like the UN and G20. These nations can now extract more favorable terms in unrelated negotiations, from agricultural exports to technology transfers. Their neutrality becomes a currency. At the same time, the conflict redraws regional alliances and sparks arms races in adjacent areas. Nations that once depended on diplomatic stability are now bolstering their security infrastructures. Egypt has accelerated negotiations with France for new Rafale jets. Jordan has requested U.S. support for expanding its missile defense network. Meanwhile, the eastern Mediterranean seas increase naval drills involving Greece, Cyprus, and Israel, signaling the emergence of new power blocks. The ripples even reach Latin America and Africa, where governments watch closely, recalibrating their own defense strategies and international alignments. Brazil's defense sector has received a 9% funding increase, citing regional preparedness. In Nigeria, talks with Israel regarding cybersecurity partnerships have intensified. The war, while physically distant, reshapes global defense priorities, influencing procurement decisions on a planetary scale. On a broader scale, this conflict acts as a stress test for the global economy's interlinked nature. Disruptions in oil shipping lanes, cyber attacks attributed to proxies, and sanctions against Iranian entities send shockwaves through international markets. Insurance premiums for Middle East maritime transport have surged by 60%. European automotive manufacturers reliant on petrochemical derivatives report delays and increased costs. Even the semiconductor industry faces instability, as rare earth imports become harder to secure due to route insecurity and supplier volatility. All of these consequences paint a picture far more complex than the traditional good versus evil narrative. They reveal a global machinery activated by war, one that operates silently, relentlessly, and with precision. A machinery in which every explosion reverberates not only across battlefields, but across boardrooms, parliaments, and stock exchanges. So when the next alert sounds and images of missiles exploding on the horizon flash across your screen, remember that war is not only a human tragedy, it is also a relentless economic engine. Bombs may destroy cities, but they build fortunes. And in this arena, the real victor is not the one who controls the land, but the one who controls the money flowing alongside the shrapnel.